For years, the crypto world has been waiting for a signal, not just another price pump or a fleeting headline, but a true system-level event that could bridge the gap between decentralized finance and the towering institutions of Wall Street. This week, a document circulating in the deepest channels of finance and crypto suggests that moment may have finally arrived. Allegedly a draft of Ripple's S-1 filing for an initial public offering, the document outlines a plan so audacious it could redefine how both traditional stocks and digital assets are valued. This isn't just about a successful crypto company going public, it's about the potential for a foundational rewiring of capital markets, starting a convergence many thought was decades away. The anticipation surrounding a Ripple IPO has been a constant hum in the background of the crypto industry. As one of the oldest and most battle-hardened companies in the space, Ripple has navigated regulatory wars, market cycles, and technological shifts. Its victory against the SEC in 2023, followed by the commission dropping its lawsuit in 2025, cleared the final major obstacle standing in its way. This legal clarity now serves as the bedrock upon which this rumored public offering is built. For investors who have held XRP through years of uncertainty, this IPO represents more than just a corporate milestone. It signifies validation on the grandest stage of them all, the public markets of the United States. What makes this rumor so potent is not just the idea of Ripple finally listing on a major exchange like the NYSE or NASDAQ. It is the implication of what that listing would represent. Unlike the IPOs of companies like Coinbase, which primarily offer investors exposure to the transactional revenues of the crypto economy, this alleged plan goes a step further. It seeks to create a direct, mechanical link between the company's equity and the digital asset it was created to support, XRP. If the details in this leaked document are true, Ripple is not just selling shares in a software company, it is engineering a new kind of financial instrument, one that could force the world's largest financial players to fundamentally reevaluate XRP. This moment feels different because it speaks to a future where crypto assets are not just speculative instruments but integral components of the global financial system. The rumored IPO isn't just a story for crypto enthusiasts, it's a boardroom-level conversation for every bank, hedge fund, and asset manager on the planet. The document suggests a future where holding Ripple stock could be intrinsically tied to the XRP ecosystem, creating a powerful feedback loop. This is the tremor before the earthquake, a warning shot that the long-promised integration of crypto and traditional finance might not be a slow, gradual process, but a sudden and dramatic event triggered by a single, game-changing IPO. When a major tech company goes public, the story is usually straightforward. Investors buy shares based on projections of future revenue, user growth, and profit margins. We saw this with giants like Facebook, Google, and more recently, crypto-native firms like Coinbase. Their value is tied to their ability to generate fees, sell ads, or provide a service. However, the rumored Ripple IPO, as detailed in the leaked filing, breaks this mold entirely. It positions Ripple not merely as a software company selling payment solutions, but as a core financial utility, akin to a clearinghouse or a settlement network. The offering isn't just about owning a piece of a company, it's about owning a stake in a new financial infrastructure. The key difference lies in the company's relationship with its underlying asset, XRP. For most companies, their product is separate from their stock. Apple sells iPhones, but its stock doesn't grant you ownership of the physical devices. In contrast, Ripple's primary mission has always been to promote the use of XRP for fast, low-cost cross-border payments. The leaked document suggests that the company is planning to use its public debut to create an unbreakable bond between its corporate success and the utility of the XRP ledger. This transforms the IPO from a simple capital raise into a strategic maneuver designed to embed XRP directly into the machinery of institutional finance. Imagine a company whose success is not just measured in profits, but in the velocity and volume of a digital asset moving across its network. That is the future this alleged plan describes. Ripple's value would not only come from its software licenses with banks and payment providers, but also from the health and adoption of the XRP ecosystem itself. This structure makes the company something new, a publicly traded entity whose core business is to drive demand for a specific, decentralized digital asset. This is fundamentally different from any tech IPO Wall Street has ever seen, creating a new paradigm for how to value a company operating at the intersection of technology and digital commodities. By framing itself as a financial utility, Ripple is signaling to the market that it should not be judged by the same metrics as other tech firms. Its competitors are not just other fintech companies but legacy systems like Swift. The IPO would serve as a declaration that Ripple, powered by XRP, is ready to compete on that global scale. This elevates the conversation from a niche crypto debate to a serious discussion about the future of global payments. The public offering becomes a vehicle to secure its place as a permanent and indispensable part of the world's financial plumbing, with XRP as the lifeblood flowing through it. At the heart of the speculation and excitement is one explosive, game-changing clause allegedly buried within the IPO filing a novel dividend policy. Traditionally, when a public company shares profits with its investors, it pays dividends in cash, typically US dollars. It's a simple, predictable process. However, the rumored Ripple plan introduces a revolutionary twist. It proposes giving shareholders a choice. They can either receive their quarterly dividend in cash, like any other stock, or they can opt to receive the equivalent value in XRP, transferred directly to their digital wallets. This seemingly simple option is the mechanism that could ignite a firestorm of demand. This XRP dividend is not just a gimmick or a nod to the company's crypto roots. It is a brilliant piece of financial engineering designed to create a direct and powerful incentive for the market to acquire and hold XRP. Think about it from the perspective of a large institutional shareholder, like a pension fund or an investment bank. If they believe in Ripple's long-term vision, they are implicitly betting on the success and appreciation of XRP. The dividend option allows them to double down on that bet. Instead of taking a small cash payout, they can choose to increase their direct holdings of the underlying digital asset that fuels Ripple's entire ecosystem. This structure creates a powerful psychological and financial link between owning Ripple equity, the stock, and owning XRP, the digital asset. For the first time, a major publicly traded US company would be actively facilitating the distribution of a digital asset to its shareholders as a form of profit sharing. This would instantly legitimize XRP in a way no marketing campaign ever could. It's no longer just a token traded on crypto exchanges, it becomes a yield-bearing instrument distributed by a regulated public company. This simple choice, cash or XRP, turns every Ripple shareholder into a potential XRP accumulator. The implications are profound. This dividend policy would effectively create a corporate-sponsored demand engine for XRP. Each quarter, as Ripple prepares to pay its dividends, it would need to ensure it has access to enough XRP liquidity to satisfy the demand from shareholders who choose that option. This isn't speculative demand driven by retail hype on social media. This is structural, predictable, and legally codified demand originating from the shareholders of a major public corporation. It's a masterstroke that links the fate of the stock directly to the value and utility of the token, creating a symbiotic relationship that could propel both to unprecedented heights. The crypto market has long been criticized for being driven by hype, speculation, and narratives rather than fundamental demand. Prices soar based on a tweet from an influencer or the promise of a future technology that is yet to be delivered. The rumored Ripple IPO, with its XRP dividend clause, would fundamentally change this dynamic for at least one major digital asset. It would shift the source of demand from the fickle world of retail speculation to the predictable and massive world of institutional capital. This is the transition from hype-driven demand to structural demand, and it's a crucial step in the maturation of any asset class. Let's break down the mechanics. Imagine Ripple has a profitable quarter and declares a dividend of $1 per share. A large institution holding 10 million shares is entitled to a $10 million payout. Under the new rule, they have a choice. They can take the $10 million in cash, or they can instruct Ripple to use that $10 million to purchase XRP on their behalf at the current market price and deliver it to them. If the price of XRP is, for example, $10, they would receive 1 million XRP. This process, repeated every quarter across thousands of shareholders, creates a constant, programmatic buying pressure on the open market. This is what analysts mean by forced demand. It's not a choice based on day-to-day market sentiment, it's a structural feature of owning the stock. For institutions that are bullish on the long-term potential of the Ripple ecosystem, choosing the XRP dividend becomes the most logical option. Why take cash when you can acquire the core utility asset of the network you've invested in? This creates a powerful flywheel effect. As more institutions choose the XRP dividend, the demand for XRP increases, which can lead to a higher price. A higher XRP price, in turn, strengthens Ripple's balance sheet and reinforces the narrative of its success, making the stock even more attractive. This mechanism is far more powerful than simple corporate treasury buying, which companies like MicroStrategy have done with Bitcoin. In that model, the company buys the asset for its own balance sheet. In the Ripple model, the company acts as a conduit, enabling its massive shareholder base to acquire the asset directly as a form of return on their investment. This decentralizes the buying pressure and embeds it into the very fabric of the stock's value proposition. It transforms XRP from something people might want to buy into something that the owners of a major US corporation are systematically incentivized to acquire, quarter after quarter. Markets are, pricing mechanisms, always trying to figure out the fair value of an asset based on whatever information is available. But, every once in a while, a fundamental change comes along that forces a complete and rapid repricing. This is what happens when the underlying demand structure for an asset is, permanently altered. We saw it happen with oil back in the 20th century, when the world shifted to an automobile-based economy. Oil went from being just a niche lubricant to becoming the absolute lifeblood of global commerce. And of course, we also saw it with tech stocks in the 90s, as the internet morphed from a government project into a commercial backbone. Now, the rumored Ripple IPO, honestly, has the potential to trigger a similar great repricing for XRP. Right now, the price of XRP is, for the most part, determined by speculative trading on crypto exchanges and, to a lesser extent, its actual use in on-demand liquidity by just a handful of payment companies. The market is basically pricing it based on what it does today and what it might do in the future. But, if you introduce an XRP dividend, that would inject a totally new, non-speculative demand source into the mix. Suddenly, the world's largest pools of capital, pension funds, mutual funds, sovereign wealth funds, would have a direct, super compelling reason to acquire XRP through their equity holdings in Ripple. That's a demand shock of a completely different magnitude. And this new structural demand isn't just some theory, it would be quantifiable. Analysts could actually model the potential quarterly demand for XRP based on Ripple's projected profits and dividend payout ratios. For example, let's say Ripple is projected to pay out $1 billion in dividends every year, and even if just 30% of shareholders opt for the XRP option, that's $300 million in predictable annual buying pressure. That number would become a core part of every valuation model for XRP, creating a price floor that's supported not by hope, but by solid corporate finance. The asset would start trading less like a speculative cryptocurrency and more like a strategic commodity with real industrial demand. This repricing event, honestly, would probably happen quickly, as sophisticated market participants would want to front-run the inevitable. The moment the S-1 filing becomes public and the dividend mechanism is confirmed, hedge funds and institutional traders aren't going to wait for the first dividend to be paid. They jump in right away, acquiring XRP in anticipation of that future demand from Ripple's shareholders. The market would reevaluate the asset based on this new reality, and that could lead to a sharp and sustained increase in value before the IPO even takes place. That's just how markets work. They price in the future, and this IPO could fundamentally rewrite XRP's future. An initial public offering on a major US exchange like the NYSE is, honestly, so much more than just a financial transaction. It's a global stamp of legitimacy. For years, XRP has kind of lived in this gray area. Regulators in some countries have looked at it with a lot of suspicion, and banks have been hesitant to adopt it at scale because of its uncertain legal status. But a successful IPO by Ripple, sanctioned by the US Securities and Exchange Commission, would instantly clear up a lot of that ambiguity. It would send a clear signal to the entire world that Ripple, and by extension XRP, is a legitimate and regulated player in the global financial system. That kind of validation would have a pretty powerful ripple effect on international banks and regulators. Think about it. A financial institution in Japan, Brazil, or the United Kingdom that was maybe hesitant about integrating XRP into its operations would suddenly see the green light. The logic is pretty straightforward. If the US, with its famously tough financial regulations, has approved the public listing of the company at the heart of the XRP ecosystem, then the associated risks are dramatically reduced. This IPO would basically serve as a de-risking event on a global scale, opening doors that were previously closed and accelerating adoption conversations in boardrooms all over the world. And on top of that, the media narrative around XRP would totally shift. For years, the story has mostly been about its legal battles with the SEC and wild price swings, but an IPO would force journalists and financial analysts to cover XRP as a key part of a publicly traded, SEC-regulated company, not just some speculative crypto token. You'd see it show up on Bloomberg and Reuters terminals, right there with blue-chip stocks. This mainstream exposure would educate a whole new group of investors and decision-makers, moving XRP from the fringes of crypto into the center of the fintech universe. And, honestly, this new status would also force a re-evaluation by global standard-setting bodies like the Bank for International Settlements and the Financial Stability Board. When a digital asset is directly linked to the equity of a major public company, it just can't be ignored or dismissed as some niche thing anymore. It becomes part of the established financial architecture. This US-based IPO would give regulatory air cover for other jurisdictions to, create clear frameworks for digital assets, using Ripple and XRP as a case study. In essence, this IPO wouldn't just be a win for Ripple, it would be a foundational moment for the regulatory acceptance of digital assets everywhere. For the last decade, institutional involvement in crypto has been, pretty cautious. Funds have dipped their toes into Bitcoin and Ethereum, but usually through things like ETFs or futures contracts. Direct ownership of most other digital assets has stayed mostly off limits, just too risky and speculative for conservative portfolios. But the Ripple IPO, with its innovative dividend structure, could change all of that overnight. It would turn XRP from an asset that institutions could own into an asset they actually need to own, either directly or indirectly, just to properly manage their portfolios. The main reason for this shift is something called tracking error. Big asset managers who hold Ripple stock are going to be benchmarked against indices that also include Ripple. If a big chunk of the return from holding Ripple stock comes from the appreciation of XRP, thanks to the dividend mechanism, then any fund manager who doesn't have exposure to XRP is suddenly taking on a massive career risk. If XRP's value shoots up and they only hold the stock, their fund is going to underperform the benchmark. To avoid this tracking error, they'll be forced to get exposure to XRP itself. So you end up with a scenario where owning XRP becomes a kind of hedging strategy for owning Ripple stock. To keep things balanced, a fund might decide to hold a certain amount of XRP directly for every share of Ripple stock they own. This creates a completely new and powerful source of institutional demand that's separate from the dividend mechanism. It's a professional necessity. Portfolio managers will now need to explain to their investment committees why they don't have an XRP position, a total reversal from the current situation where they have to justify why they do. And this necessity is going to spawn a whole new ecosystem of financial products. We'd probably see the rapid approval of XRP ETFs, custody solutions from major banks like BNY Mellon and State Street, and the development of a regulated derivatives market for XRP futures and options. Wall Street honestly is great at creating products around assets its clients need to own. The IPO would basically be the starting gun for a race to build out this institutional-grade infrastructure, making it even easier for trillions of dollars in institutional capital to flow into the XRP ecosystem. It's a stampede that would be triggered not by choice, but by the fiduciary duty to perform. If these IPO rumors are true, we're witnessing something way bigger than just the public debut of a single company. We're actually seeing the first draft of a whole new blueprint for the future of finance, a future where the line between traditional equity and decentralized digital assets starts to blur. The Ripple IPO could honestly become the pioneering case study for how to bridge the world's two largest pools of capital. It shows there's a viable, regulated path for public companies to directly integrate a digital asset into their corporate structure, creating value for both shareholders and token holders at the same time. If this model works, it's going to be copied. Imagine a future where other companies with deep connections to a specific crypto protocol do the same thing. Like, a decentralized storage company could go public and offer a dividend in its native storage token, or a gaming company could IPO and reward shareholders with its in-game currency. This creates a really powerful new way for companies to align their investors with the success of their ecosystems. The Ripple IPO could set a precedent that unlocks a whole wave of innovation, creating a new category of publicly traded assets that are part stock, part commodity, and part technology platform. But of course, this convergence also brings new complexities and risks. The volatility of the crypto markets could spill over into the equity markets in a much more direct way. A sharp drop in XRP's price could drag down Ripple's stock price, even impacting major stock indices like the S&P 500. Regulators would have to grapple with these new, interconnected systems and the systemic risks they might pose. The limited supply of an asset like XRP could also lead to some pretty extreme price volatility as institutional giants compete for a finite number of tokens. Being unprepared for this shift could be just as risky as ignoring the rise of the internet. In the end, the Ripple IPO rumor really forces us to ask a fundamental question: what is the future of value? This plan suggests a hybrid answer where the legal certainty and established infrastructure of public equity markets are combined with the efficiency, transparency, and global reach of digital assets. It represents the maturation of the crypto industry, from a rebellious outsider to a powerful innovator working within the system to change it from the inside out. And whether this specific document is real or not, the ideas it contains are now out in the wild. The merger of equity and crypto isn't just a theoretical concept anymore. It's now a plausible and maybe even inevitable next step in the evolution of global finance.